What's up everyone, it's Caddy with Money Vesting. I literally recorded halfway through in this video and then realized my stupid microphone was not turned on. So I'm pretty much re-recording this. But in this video, my goal here is to share the time lags associated with monetary policy, where we are in this cycle, and what I believe could be something that could blindside the markets in 2023. So there was a really interesting email sent to me by one of the members asking about the time lags associated with monetary policy. So we're going to talk about the three different types of time lags, where we are in those cycles. I'll share some of the other indicators, some of the other data points which are concerning a little bit, at least for myself, and then how this could play into the overall dynamics of the economy and the markets in 2023. So hope you guys enjoy this video and find it helpful. If you do, don't forget to subscribe to the channel. Make sure that you drop the like button as well, because I am re-recording this video, and the link to our Discord and Patreon is going to be down below. It is the first week of the month, usually the best time to join, and we're going to be starting a real strategy in April of 2023. So if you're interested in all of that, as well as private videos on our Patreon, link's going to be down below for you to join. And now let's just dive right into it. The first thing that I wanted to go over is a very, very quick pop quiz, and I've already given away the answer, but recognition lag, implementation lag, and impact lag are all examples of what? And it is going to be time lags associated with monetary policy. And you'll notice, and I'll explain what each of them are, and also go over where I think we personally are right now. But implementation lag is simply the time lag between monetary policy and the actual implementation of the said policy, right? So for example, the Federal Reserve raises rates by 25 basis points. How quickly or how soon do we see the corresponding rates, whether it's the 10-year yield, whether it's the credit card rates, auto loans, mortgage rates, how quickly do we see those rates move up with the implementation of the federal funds rate, right? So that's the implementation of the said policy. That's the lag between the Fed funds rate, which is what the Federal Reserve controls, and all the other interest rates that are corresponded or pretty much get affected by the federal funds rate. The impact lag, on the other hand, is going to be the time lag between monetary policy and the actual impact to the economy, right? So for example, if mortgage rates start pushing higher, we'll start to see mortgage demand come down, right? Because that's, economics 101. As cost of borrowing increases, demand for money, demand for borrowing decreases, and that's the impact on the economy. So that is simply a time lag. It happens over time, right? You're not going to see mortgage rates go up to 7% in an instant, and then the next week or next month, you're going to see the demand fall. No, it takes time, right? It takes a few months, several months for that to play through. And recognition lag, I think, is the longest type of lag, which is basically the time lag between monetary policy and an actual recognition in the economy that we are now starting to see the effects of the higher or lower interest rates. So the Federal Reserve, as they have already mentioned, that they're going to be data dependent, and they want to actually see the impact and the recognition both are going to come with that time lag. Now, the reason why this is so important for us to go over, because we already know how the Federal Reserve has behaved over the last year. So this is the last 1 year's worth of rate hikes, and it's literally been 1 year. So 1 year ago, March 2022, we were at 0% interest rates. This has been the most aggressive and the most hawkish Federal Reserve we have seen in the modern era, in the modern sort of economy. And you'll notice that we actually had a little bit of a curve. So we got up to 25, 50 basis points, and then 4 consecutive hikes of 75 basis points, and then finally cooling off a little bit in the last couple meetings, 50 basis points, and then down to 25 basis points. And now there's expectations that the Federal Reserve is going to raise rates by 50 basis points, potentially in March. Once again, March 22nd is when we have the next Fed meeting. So what have we seen with these rate hikes? What we've really seen is the markets get affected, right? So obviously in 2022, it was a completely risk-off environment. The stock market got devastated. It was destroyed. I mean, tech and growth and, those sectors were down 19, 20, 30, 50%. It was more like a risk-off environment overall in general, right? Crypto was down. The 10-year yields shot up. Credit markets were, tightening inversions in the yield curves. So there's a lot of things that happened. But when you take a look at the economy, right? When you look at some of the data points in the economy, they are still resilient, right? So if you take a look at the economic change year over year for the US economy, 2.1%. By the way, we're going to get that third quarter GDP numbers at the end of March. I shared the calendar for the GDP numbers coming out. in 2023, all the numbers in our Discord. So if you go over to the market updates channel, you should see the calendar for the GDP numbers that are coming out. But third and final revision is going to come out at the end of March. That's going to be for Q4 and for entire 2022. The expectations are for us to see 2.1% year-over-year growth. That is very good growth. That is actually really good growth on a year-over-year basis for the economy. If you take a look at the unemployment numbers, right, we're sitting at 50-year lows at 3.4%. These are, again, really, really low numbers. We're sitting at a very, very tight labor market. So on one hand, you've got such high Federal Reserve rate hikes, right? You've got 75, 75, 75, 75, 4 times in a row. And then you're pretty much going from 0% to as much as 4.5%. And now the Fed funds future is pricing in at a terminal rate of 5.5%. And there's possibilities for us to even see as much as 6% sometime in July and September of this year. So the two really just don't add up. On one end, you've got the Federal Reserve hiking rates like there's no tomorrow. You've got the economy that's super strong. You've got unemployment that's super low. And you've got retail sales getting a bit of a bounce here in January, 3% increase in retail sales. This right here, once again, you're seeing a big change in retail and food services sales from previous month. December and November was a contraction. But once again, January, we're starting to see a little bit of a pushback higher. This is where I think we currently are. Right now, I personally do believe that we are in an impact lag. What that means is that there is a time lag between monetary policy and the actual impact to the economy. Because to me, it actually doesn't make sense because of the fact that we are seeing such high interest rates, and for the Federal Reserve to keep raising rates, they're already behind the curve, obviously, right? They were behind the curve since the beginning, and now they're doing it to a point where it can be overdoing it because inflation's still high, so they need to keep at it, right? So they need to keep pushing the envelope here and keep going after it to potentially decrease inflation. But at the same time, they're doing it at a pace which is far, far faster and far more aggressive than what we have ever seen from a modern Federal Reserve, right? Of course, it happened for Paul Volcker. It happened overnight. And a lot of people actually don't even remember that during the 1979s, when there was great inflation, Paul Volcker was in charge. They raised rates to over 17.5%, closer to 20%. When inflation started trending lower, what they really did was they pulled back on interest rates. They pulled back on interest rates, and because that caused a huge recession, 20% interest rates back in 1970s and 80s, that caused one of the most devastating recessions, and it caused unemployment to be much higher than that of the Great Recession in 2007, 2008. So they pulled back, Paul Volcker pulled back on interest rates, and guess what happened? Inflation once again spiraled out of control and went higher once again. That's why we've got a double top in inflation from back in great inflation in the 1970s and 80s. So that's one thing that Jerome Powell does want to avoid. That's something that Jerome Powell does not want to do, right? They don't want to prematurely loosen policy and make inflation go higher once again. So because of those reasons, interest rates, as we know, are going to be higher for longer. But I think that one of the things that's getting blindsided here, and it's getting lost in translation, is the fact that there could be a pretty severe recession, which I think is not getting priced in from the markets appropriately, considering the impact lag, considering the fact that we are not able to see right now what impact there is going to be in the economy with respect to higher rates, which are going to go higher for longer. And the reason I also pointed out implementation lag is because we're right now, the Federal Reserve is hiking rates as we're also seeing impact lag play through, right? So it's not like the Federal Reserve stopped, right? It's not like they're done. They're raising rates as we are speaking, and the economy is probably going to go through an impact lag sooner or later. Eventually, there will be. In the middle of this year, probably at the end of this year, we're going to see the impacts of these higher interest rates. It's just inevitable. Now, some of the other things that I wanted to go over, which are also a bit concerning for myself, maybe not for you, but definitely something that I wanted to talk about, is the total debt levels, right? Consumer debt has been going crazy. So we are now in 2022, as of the fourth quarter, sitting at over $16.3 trillion, and that's up 7% on a year-over-year basis. And just 3 years ago, we were sitting at $14 trillion. So that's, again, increased by over $2.3 trillion. This is a little bit more of a visual representation, and I'll kind of break that down between housing versus non-housing debt. But right now, we're now sitting at 16.8 trillion. We were going down a little bit, so we were pretty flat at around $8 to $12 trillion in total debt between 2008 and 2020. So that was right the time when we pretty much were consistent and flat and stable. But of course, after all the money printing and the stimulus pumped into the economy, we've seen nothing but easy money and as a result, more debt in the economy. This right here is a breakdown by debt type. So what you can see is mortgages, $11.2 trillion, and that's up from $9.5 trillion, up 9% year over year. We have seen home equity up 9.3%, HELOCs, which are home equity line of credits, up to 3.5% increase, $305 billion. Student loans are down on a year-over-year basis. Auto loans have increased 1.4 trillion. Auto lease are up 71 billion, down 23%. Credit cards are up the most, which is the most concerning part of this because they're the ones that have the highest interest rates, and they're up to almost $1 trillion. If you compare credit cards and retail credit cards, they're combined over $1 trillion in debt, and they're up 16% year over year. Retail credit cards slightly down, and personal loans are up 18% to over $500 billion. This right here are going to be some of the average balances. Credit card balances almost $6,000, mortgages over almost $250,000, HELOCs $41,000, student loans $40,000. Auto loans $22,000, retail cards $1,100, and personal loans over $18,000, with the average balance of a household sitting at over $101,000 in debt. This right here is going to be the breakdown by geography. So in other words, age group. I'm not going to go over that in too much detail. And this right here is the household excess savings and how we have come down from, way over $2.1 trillion in excess savings to now sitting at less than $900 billion. So that is a pretty substantial drop. And that $900 billion from JP Morgan is expected to run out by the middle of this year if inflation doesn't come down. If prices remain as high as they are, and especially when we're talking about oil, gas, groceries, some of the more main utilities that people spend money on, if those prices don't come down, unfortunately, the excess savings will run out at $900 billion. And it's already come down so much, and the savings rate we've already gone over before, but 4.7% is where we are. So in other words, for every $100 in a consumer, in an average person that generates in the US in terms of their income, $4.70 is actually saved. Isn't that crazy? That is absolutely the most crazy, bizarre number that you can ever think about. Only 4.7%. It has ticked higher a little bit from October lows. So consumers are forecasting a little bit of a recession scenario where they are being more cautious, but that is definitely still a lot lower. Imagine where we were. We were at 33% during the pandemic. That's how high the savings rate was. Now it's 4.7%. This right here are the delinquency rates. And as you can see that in the fourth quarter of 2021 to fourth quarter 2022, we are seeing a bit of an uptick, especially if you consider credit cards, 3.2% to over 4%, mortgage debt from 0.3% to over 0.5%, HELOCs from 0.3 to 0.5%, and we do have the other category, which is personal loans and business loans and whatever, 2.9 to almost 4%. So delinquency rates are also rising as savings are going down and interest rates are going higher and cost of living is increasing. So to me, this a lot seems a bit like a ticking time bomb, unfortunately, when it comes to the consumer spending. Maybe we kind of power through it. We'll see. But unfortunately, as the data suggests, we cannot sleep on this. And this is something that definitely needs a lot of attention moving forward, because if consumer starts to run out of cash, spending drops, and guess what happens next? Earnings drop, and earnings dropping lead to a potential recession. Economic growth starts to pull back, economic spending starts to pull back, and not only do we get an earnings recession, we also get an economic recession. And the problem with that recession situation is the markets have pretty much never bottomed before a recession started, at least not since 1960s. We can even go back to World War II, but the markets have most certainly never bottomed before a recession started. So you can pretty much see here when the recession started and when the S&P 500 hit a low. Every single instance we've seen the S&P 500 hit a low after the recession started. So, and again, you can see there's been lags here to 12 months, 8 months, 15 months, 15 months, 18 months, 21 months, 1.5 months, so on and so forth. But the bottom line is, if there is a recession, we have to certainly be prepared for potentially new lows in the market. So lesson 2 is that stocks have historically not bottomed before the recession starts, typically 5 months after the economic contraction begins. And if the high odds of recession in 2023 are correct, stocks could still hit a bottom very near that time, since stocks have bottomed 1 month after. But there is a small probability that the US economy could avoid a recession. If that is the case, which would probably mean the stocks already bottomed in October. So that's really the dilemma here between recession and no recession. In other words, whether we get a, like a no landing or a soft landing or a hard landing, whatever that is. But in my view, if inflation turns into stagflation in the economy, then that leads to even more hawkish Fed, right? What is stagflation in a nutshell? It's higher inflation, right? It's inflation which is sticky, it is stagnating, and it is at a much higher level. So that turns into more hawkish Fed, meaning that they have to continue to increasing rates. We could even get up to 6%, even higher. The balance sheet runoff could be more aggressive. The bond market could continue to spike even further. We're just seeing the 10-year yields past 4%, the 1-year yield past 5%. That could continue, and that will eventually, and I know we can't see it right now. Trust me, I know economy's strong, unemployment's good. Nobody wants to talk about recession, and I know it's the least talked about topic. Maybe not in this sort of environment, but if we continue to see rates higher for longer, there will most certainly something that breaks. There will be a breaking point in the economy eventually, which will lead to a recession that could affect earnings to a level where we could see a new low. Just want to make sure that you're aware of this scenario so it doesn't blindside you. And that's going to pretty much bring up our recession playbook moving forward. So I hope you guys enjoyed this video and a complete update on the markets. Make sure that you drop a like and subscribe. Just wanted to kind of share this one potential outcome in the markets, and let me know your thoughts on this as well. If you enjoyed this video, found it helpful, drop a like, subscribe, check out the Discord and the Patreon links down below if you're interested in joining us. As always, happy investing, and I'll see you all in the next video.